Good morning, everyone. Thank you for joining us today. I'm Isis from Client Portfolio Management Team. Today, we have two portfolio managers from our Greater China Equity team to join us on the topic, what's next after the rally? On my right-hand side is Wenlin Lee, and on the screen, we have Ben Yu joining us from Taiwan. Welcome, Ben. Welcome, Wenlin. So my first question is to Wenlin. So China has been doing fairly well this year. Do you think it is sustainable? And what's your view on China economy next year?
Thank you. Well, we are positive on the China economy, especially first half next year. Looking back this year, we have two conclusions. One is China is the first country to pass through the COVID, thanks to the good government control and very fast reaction. So we can see that Q1 economy reached a trough because of the lockdown, and Q2, Q3 we have a sharp V-shaped recover. Meanwhile, all of the other major countries globally, they are still suffering from the COVID, and recently there's even a second wave. The second conclusion is China export actually benefit post-COVID. We can see that China export down more than 25% when the COVID just ramped up globally. And the export numbers have a sharp recovery since end of Q2. And in November, China export grow more than 20%. China's export global market share reached historical high. Reason is also very simple. China is the first country to resume productions. And all of the other countries' supply chain is still suffering from the COVID. So China is taking the responsibility of global production base. Looking into 2021, I think several drivers is positive for the economy. First one, we believe the export trend will continue. Secondly, we believe that domestic consumption will continue to recover. Some of the consumption like travel, like hotel, restaurant, they are still below the normal level even now, which will be better next year. Third reason is PPI, i.e. the industrial products pricing index, is gradually recovering, which is normally good to the corporate earnings. So all in all, we are positive to the China economy, especially first half, on a very low base.
Good. That's good to know. So Wenlin, to follow up with you, against this relatively healthy macroeconomic backdrop, so what's your outlook for China equity next year?
We have two markets, right? So for China A, we think that China A share market still have more upside, despite the strong performance this year. Looking at the valuation is had historical average level, so it's not stretched, so therefore the liquidity, even though the domestic liquidity is marginally tightening, we do not believe that it will hurt the valuation materially. Meanwhile, the corporate earnings will be very strong, especially first half next year on a very low base. Normally, in this scenario, equity market have very low risk. We are also positive on the Hong Kong market. We can see year to date, HSI is flat, while the Asia index up more than 25%. Part of the reason is due to the relatively weak domestic economy in Hong Kong, and part of the reason is because HSI is more dominant by the traditional industries. Valuation of the Hong Kong market is almost historical low. So anything positive happen in 2021, like vaccine, we believe that Hong Kong market is likely to perform. Meanwhile, despite the lackluster index performance, we can see several sectors' performance was really good this year. For example, some of the tech names, some of the internet names, healthcare, property management, and some of the new IPOs. So which shows that the market activities is still very good in Hong Kong. And also, if you look at the southbound inflow, it was really strong, especially in the second half. Also showcase that domestic investors are more and more interested in the Hong Kong market. So all in all, we are also positive in the Hong Kong market.
Thanks, Wenlin. So let's turn to Taiwan then. So Taiwan equities also have a good year this year. And I'll ask you the same question. After the rally, what's your outlook for Taiwan equity next year?
Okay. We are still positive in the first half of next year for Taiwan market with four reasons. Firstly, Taiwan doesn't have any impact of COVID-19 this year. Our GDP growth rate estimate is 2.5% this year, which is one of the best number in Asia. In 2021, Taiwan GDP will also be improved to 3.7%, even with if we already have a relative high base this year. Moreover, our estimate of earnings growth for next year is 18%, which is also based on the 10% high base of this year. Secondly, the liquidity is still quite good in Taiwan as QE and weak US dollar. And for Taiwan Central Bank, we still have room for a rate cut. So the liquidity is still quite good. Thirdly, we have some structural growth story in semi sector and the new product cycle in tech downstream. Finally, Taiwan is the key beneficiary of tech conflict. After U.S. Election, we think U.S.-China trade tension may ease in the future, but tech conflicts will remain the same. We think protect IP and high-end technology will still be the core policy for U.S. In the future.
Okay, thanks, Man. So since both of you are quite positive on the Greater China equities next year, then let's go deeper as to what specific sector or investment themes that you are most excited about. Wing Lin, maybe you can start to share with us first.
Yeah, we continue to be positive on several structural opportunities. To give you some examples, like chipset, despite the tech conflicts between China and US, we believe that China will eventually have its own chipset value chain. Second is biotech. We still see big opportunities here because generic drugs still dominate in China. Third is EV. Starting from this year, it is becoming more and more clear that EV is a global trend. Aside from those startup EV companies, we also see opportunities in the traditional car companies and also in some of the auto component companies.
Thanks, Wing Ling. That's interesting. So here, electric vehicles, semiconductors, and these themes and sectors are also very relevant for Taiwan. Ben, do you see similar opportunities in Taiwan?
Of course, we are also positive on semi and the EV sectors in Taiwan. For semi sector, Taiwan has the best foundry in the world. Our semi supply chain and the IC design house also have a quite good position. Both of foundry and the IC design house are the key beneficiary of tech conflict. For EV, investors can buy a lot of EV components or EV brands in Taiwan. However, in China, sorry. However, in Taiwan, we have a lot of EV components in tech upstream, especially for power-related semi-components. Moreover, we can also find a lot of new product cycle in tech sector, such as the new generation of wireless transmission. Data transmission is getting bigger as high quality video and live stream. So people need like Wi-Fi 6 or 5G to improve transmission speed. And mini LED is another example. Like America brand and Korea brand will launch a lot of mini LED product next year.
Okay, cool. Thanks. So that's pretty much that we covered the Taiwan equity, Greater China equity. Then let's turn to some questions that we received from the audience. Okay, so first, I received the interesting questions. Maybe this one I asked to Wing Lin. So there's a lot of hot IPOs coming to China equities. We see IPOs coming to Hong Kong and the mainland market as well. So with the reforms in the listing rules in both places, what can investors expect for China equities in the longer term perspective, say a few years' time?
I think it's the what's happening. The recent moves in Hong Kong is definitely a good move for the market. 2-3 years ago, the market does not fully reflect what is happening in China. Not to mention that what is the future of China. We can see the index was dominated by traditional industries like property, like finance, like energy, like telecom. Investor cannot buy the internet companies. They have to go to US. Several of the pre-profit companies like biotech companies, they cannot be listed in Hong Kong. In the past 2 years, I think Hong Kong market is becoming more and more flexible on the listing and is more open to the new economy, and the market structure is becoming more reasonable. The US, I think, is a best example. In the past 30 years, we can see sectors like healthcare, tech, consumer, industrial, was becoming more and more important in the economy of US, and also is gradually taking the index weight, replacing those sectors like energy, like finance, like telecom. We believe China is actually evolving along what happened in US. Therefore, the China capital market should also evolve along the same path that happened in US in the past 30 years.
Okay, yeah, good, thanks. And then I got another question, also interesting one. Probably I will ask both of you. So market has been worrying about the Sino-US trade war and tech conflicts. And actually, do you see any beneficiaries you can find in the investment space for Greater China equities? So Wing-Lin, would you mind to share first?
Yeah. First, we believe that the tech conflicts could marginally ease after the new US president. However, we believe that the conflict will last for a long time. We can see that China imports 2/3 of the global chipsets. In order to migrate from the very low margin ODM business, assembling business, and in order to get more profit along the value chain, Chinese companies have to go more upstream to the chipset industry. We can see since 2018, China governments and Chinese corporates are more and more determined to go self-sufficient on the semi industry. Along the value chain, we've seen more and more new companies, new startup companies like in semi equipment, material, foundry, fabless. Versus several years ago, there's only very few investable companies in the market. So yes, we do believe that the trend will continue, and we do believe that give it 10 years, 20 years time, China will become more and more self-sufficient in the semi industry.
Okay, yeah, thanks. So Ben, do you have any more to share about the tech conflicts beneficiaries?
Yes. I think we know Chinese tech companies improved their technology a lot in the past few years. However, for advanced technology, besides US, Taiwan is one of the best choices. I give you some example in the past few years. In 2018, Taiwan benefited from China-made power amplifier. Since 2019, Taiwan has benefited from US IC replacement trend in China, and also benefits from China-made IC. I also take China-made CPU for example. This China CPU adapts Taiwan IP and foundry. So we see more and more Taiwan IC inside in China products. And for next year, we think China still need to leverage Taiwan semi companies. So those semi supply chain will still be the key beneficiary, especially for foundry and fabless. Thank you.
Thanks, Ben and Wing-Lin. So the developments can go hand in hand and then jointly beneficial. Another question I received from the audience. So this one I will ask to Wing-Lin then. So what is the biggest risk factor that you are seeing for the China economy right now?
Actually, I'll touch base a little bit on the already. We've seen that domestic China liquidity was marginally tightening, which is also reasonable because China economy this year is actually above everybody's expectation. So it's becoming, several issues that has already been emerging. For example, like increasing of the macro leverage ratio, and also some of the property price increased a lot, right? In selectively in several cities. So I think the government has already sensed that, and they are trying to tighten a little bit on the liquidity domestic, which can be hurt the whole market's valuation. But we believe that it won't happen in first half next year. If the trend, we will closely look at the trend, and if this trend continues, there will be increasing risk in second half next year.
Right. So, okay. So first half will be less risky, and then second half we need to closely monitor.
Yes.
Right. Yeah. Understood. And then I got another question. That is maybe I asked that to Ben. So for the semiconductor development in 2021, any exciting development that you can share with us, Ben?
I think our foundry side, their technologies keep improve a lot, especially for those advanced technology. So I think we can keep gain market share from that. And for the IC design house, we're still in the trend of USIC replacement in China. So we can see a lot of opportunities like in wireless, and a lot of China-made IC like power and profile. So I think these two sectors will keep beneficiary from tech conflict trend in the future.
Okay. So good. So pretty much we cover quite a lot of questions. So there's actually more coming up. So maybe this one I asked to Wing Lin. So how is the China like compared to other countries in terms of the market valuations and also earnings growth for 2021?
We continue to believe that. I mean, what happened in 2020 is China outpaced almost every other countries globally to fight against the COVID, right? So, which also showed that in the China economy recovers the almost the fastest in globally. We believe that the trend will continue, and China corporate earnings, as I just mentioned, that not only benefit from the resume of domestic consumption, but also benefit from the increasing of PPI. PPI has been negative in China for more than 2 years. The rising PPI is normally good for the corporate earnings. So we are still very positive to the first half of China's economy, and we believe that there will be very limited risk in the market for China. Yeah.
Right. Okay. So another question, actually, Winnie has also touched on, is about kind of the liquidity tightening, and also the Chinese companies some bond or debt default issues in recent months. So do you think there will be any impact to the Greater China equity market as a whole, and then how do you would address it?
First of all, we are doing the equity, not the bond, but yes, the bond market is happening several of the defaults, especially on some of the local SOE, some of the private companies. However, we believe that this round is more like Chinese government want to fortify the bond market, want to correct the bond rating system, want to ask the corporate to pay back their debt rather than default forever. I think this is actually fully controlled by the government, and we believe that there will be very limited risk for the bond market's risk to expand into the economy.
Right. Yeah. I see. Understand. Okay. Another interesting questions I will ask to you both. So what sector do you think has the most upside from your current forecast? Maybe this time we can start with Ben first.
I think at this moment is December of this year, so we really do try to do more deeper research on IC design house to find the new beneficiary of those trend I mentioned before. So I think for next year, the most upside should be still in tech sector in Taiwan, and we also notice and we also lack some tech cyclical names because they have a relative low base this year. And for next year, they really do have a price hike opportunity in the first half. So these two sectors are our preferred sectors.
Understand. Okay. And Winglin, how about onshore and offshore? What sectors do you think has the most upside from your current forecast?
I think it's the same. This year, the some of sector valuation becomes really expensive, like some of the consumer names, some of the healthcare names. However, in second half, the market gradually realized that China economy is way above expectation. For example, for heavy duty truck, right? So in the first half, people forecast this year growth is like 20% something each, and in second half is people realize that it's way above their expectation. And same thing happened at excavator. First half, people only believe that 20% growth, and in second half, every month we have more than 60% growth. We believe that the COVID not only helped those healthcare companies, but also help some of the industrial, some of the manufacturing companies to upgrade their products, to let their products entering into more new customers. Previously, this customer can be dominated by the foreign corporates products, or to expand their market from domestic to the overseas. We've seen several automation companies growing up. We've seen several industrial companies growing up, and we've seen some new material companies growing up. We believe that these cyclical or these growth plus cyclical sectors was kind of overlooked by the market in first half and was gradually realized in second half. And in terms of the earnings revision, we believe those sectors could be the most have the most upside in the first half next year.
Thanks, Winglin. Understood. So other than the semi and the EV that we talk about, actually you're also positive on growth and some cyclical sectors as well for onshore and offshore China equities. So I think the last question is, we talk about a lot about the tech conflicts that we understand the growth stories behind. And there's a question from the audience saying that, what about the trade conflicts re-intensified? And how would you think that will affect the greater China equity space? Winnie, do you have anything to share?
Yeah, we believe that it's very unlikely to be more intense. We believe after the new U.S. president on board, the trade tension could be marginally eased. The reason is also very simple. When Trump raised up this trade war, he said that the purpose is to bring manufacturing back to U.S. But after in the past 3 years, 2-3 years, this hasn't been happening. So the trade war's only result is increase the tariff and increase the product price, and those things are actually bared by the U.S. consumers. So I think the Biden could be marginally ease the trade war, and also they try to negotiate, of course, with China on any other things, but the trade war. Since the effect is not very clear, I think this can be eased. And also, as I said, China export really above expectation. So it showcases that China export is definitely inevitable in the global value chain. I think U.S. gradually will realize that. Yeah, if the tariff was kind of released, it will definitely positive for the export companies.
Okay, thanks. Okay, thank you both Ben and Wingling today. So lastly, if I can just remind all of you to share your feedback to us for this section, that would be great. Everyone have a good day and have a good year.